Thanks to Nick, thanks to Paddle. Thanks to Paddle and thanks to Alex as well. Super excited about being here. You know, I knew we were going to do the live interview, try and do a live interview, so I'm trying to like soft sell it ahead. I'm going, okay, who could I try and convince? Like, go Satish, come on, dude, come on. No one's going to say yes to this. You got to come up. Has anyone been on the show before? Stand up. If you're a founder, you've been on the show. It's a smart group right here, very smart group. It's a smart group. No, so long story short is I launched and sold my SaaS company back in 2015, and it was in the mountains of Virginia. If you're not from the States, Virginia is like, well, the mountains of Virginia is sort of middle of nowhere. And I didn't have a lot of data. So what I did is I started trying to interview or actually meet with other founders to learn, but no one would return my emails. When I changed the subject line to I want to feature you on my very popular podcast, which didn't exist yet, everyone said yes, right? And so I just said, we will have 1 million downloads by the end of the summer. You must come on. And I'm like, I better go get 1 million downloads. Otherwise I'm going to look very, very silly. So raise your hand if you listen to the podcast. Okay, don't be shy. Yeah, stick them up. Okay, cool. So a lot of people listening. Oren, how would you describe it? Just yell it out.
Best.
Abyss?
The best.
Oh, the best. Abyss, the best. I'm going to go with the best. I like that. Who else listens? Now you know. Okay, how would you describe it, Hugo?
Top class.
Top class? We named it the Top Podcast, and people go, why do we name it that? Well, it's because when I launched it, I looked up SEO and I said, what's the number one search word for podcast? And it's, what's the Top Podcast? And I said, fuck it, I should name it the Top Podcast. So we got 1 million downloads by the end of the summer. So what we were about to learn together are 6 valuation data points. This is specific for you guys, European founders, specific to London. It's customized. I never give the same presentation twice, so it is customized. And one of the things that I want to do to set context for this is my first cap table, my first SaaS company. So I'm gonna just let you guys sort of digest that. Go down the left side and look at all the percentages, right? And then look at the labels if you can. I'm testing myself here. Look at the labels if you can to see what those percentages were, right? So that first one is 2.88% to an angel, right? If I go down to that blue check mark, that's me at 38%. If I go down to this long one, adult supervision COO, when you raise from the mountains of Virginia, the people on the West Coast want you to have an adult supervision COO. You don't know that that's going to dilute you, but that's how much it dilutes you. Right? That's what it diluted me, right? And then the actual round, right? You go down was 19.08%, right? Series A, and then you also have to set up obviously your stock option pool on top of that, right? ESOP pool, right, for employees, 5 to 10%. So if you guys do the math. All in dilution, we were at about $1 million in AR at this point. All in dilution, right? 2 million on a 10.5 post money. That's why I'm down at 38% with $1 million in ARR. Now, just by a show of hands, raise your hands if you think that's a good percent, 38.06%. This isn't a trick question. There's no right or wrong here. It's just testing the room. Yeah, raise your hand if you think 38% is good. Post Series A, $1 million ARR. Okay, so everyone else is no. You sort of shake your head. Why do you sort of go, I'm in the middle?
Because I had co-founders before, and that's relatively high once you have co-founders.
Yep. So my co-founders are 2 right here, right? So 8% and 5% together. Your co-founders are the most dilutive event. Right? Day one, that's your most dilutive event is if you have co-founders. So get that right. 50-50 is rarely the right answer. Because basically what that means is you can't have the tough conversation about who's more valuable. That's usually what that means when I see 50-50. People say, oh, we're rainbows and butterflies, we're going to be equal. Like, that's cool too. But it's not always rainbows and butterflies. So anyways, long story short is everything you're about to learn. And the reason I was curious to interview SaaS founders is because I got super diluted. I didn't know what I was doing. We had 25 on the team. If you've has anyone read the book that I put out? A couple people, Hugo goes, oh, a couple people. Wait, raise your hands higher. That's great. Anyone remember what's on page 243? You get a real big bonus if you know it's 243. Oren, what's on page 243? You have it? Or sorry, Hugo, do you have 243? All right, I'm gonna come back to you in a second. Okay, go to page 243. I'm gonna come back to you. All right, this is kind of cool. I like it. There's some books in the audience. It's great. All right, we'll come back to that. All right, so again, here's the content. Here's the slight delay. Here's the content we're gonna go over today. Right, so 6 data points specific to European SaaS founders. The first 2 points we're gonna talk about are over there on the left. Right, they're over there on the left. Right, and this is literally just David, Goliath, whatever you want to call it, right? I'll give you the bullet version here. It's not fair. European SaaS founders, in terms of just pure valuations, you have the equal company in the EU versus the equal one in the States. The States one is always going to get a higher valuation. And I'll show you proof and I'll show you why I think it's going to change, right? Multiples are also very polarized. A lot of people don't understand. They say, well, what's the valuation market like? Well, the US Fed's increasing rates. I don't know what the equivalent is over here, but yes or no, are they increasing rates over here?
Yes.
Yes, okay. And what's it called?
Bank of England.
Fucking good branding. The Bank of England is increasing rates over here, right? So multiples are very polarized. What I mean by that is VCs are paying higher and higher valuations, and buyers are paying lower and lower valuations. Right, so the spread is much larger. What does that mean for you guys? That's that first section over there on the left. The middle section is key metrics. So if you're already on the raise path and you want to minimize your dilution, which means you got to maximize your valuation, what are the 2 metrics you should like quadruple down on? It's not what you expect. Revenue growth is not the most important one. I'll dive in and show you why with proof. And lastly, founder tactics that are not normal. You're gonna see real LOIs and real contracts on slide 35. The one Henry Schuck used at ZoomInfo in 2012 to do a secondary. Secondaries are happening more and more. It's how founders get rich as they raise without having to decrease their optionality and only make money on an IPO. We'll talk about how to do a secondary. Has anyone done a secondary in their company? Anyone done secondary? Or if you see, some of you may have, but you haven't. God, I'm not gonna put you on the spot. No secondaries? Andrew did. At your first company or Paddle? You did it at Paddle? You're not supposed to be selling Paddle shares, dude. Huh? Oh, everyone. It was a group effort. You all linked arms and jumped in the pool together, right? All right. I think Paddle is very undervalued. That's on slide 40. I hope that's okay. Christian's not here, so we can go deep on this. No one will tell him. But we'll go deep on that. All right. So yes or no, sound good?
Yeah.
6 points. All right, 6 points. All right. Now again, I'm not a smart guy, I just curate. These are some of the interviews I've done. You know the guy in the upper left. He's in the press recently. Also the fastest growing, but also not liked right now by a lot of people, right? That's Johnny at Hopin. You got Wade Foster in the upper left at Zapier. These are all now multi-billion-dollar valuations. Many of them I'm interviewing pre-revenue here, or very early revenue, right? Girish at FreshBooks recently, obviously IPO'd. Nick Mehta is a Vista deal. GitLab, obviously IPO'd. Who else? Matt at Automatic owns Tumblr and WordPress. Obviously everyone knows Matt. He doesn't do a lot of interviews. So I just take snippets from these and then I share them with you. So nothing I'm sharing you with new as I learn from other people. And here's how the data process works. I do the one-on-one interview, and this is why no one wants to come on until you realize like how big the audience is, and then you want the extra exposure, right? So I interview them one-to-one. We verify any valuation data that the founders verbally tell me. Right, I do that obviously by publishing the interview. They want data to be obviously accurate on the interview. And then I send a mail merge email, right? So we're doing all the interviews. We've done it's now up to about 3,000. I've done personally one-on-one. That's what my day looks like when I'm doing interviews. And then this is the mail merge email I'm sending out. And this will go out to 3,000 founders, right? Confirming all the data is accurate. So I get then confirmation via text. We take all this and put in the reports that you're about to see today, right? So that's how all the data works. Let's dive into the first section here, right? Which is sort of EU versus the USA, right? How do the valuations compare? And then we'll talk about polarized multiples. In terms of EU versus USA, let's look at Cognism, right? Now, I think there's are there Cognism people here today? Anyone? Or ex-Cognism people? Okay, there were last night, but this is what Cognism's revenue growth looks like, right? And the source here is me interviewing James, right? So you can see launched in 2016, they're sort of flat through 2019, and then they really hit it, all right? They're now up to about 25 million bucks in ARR in 2022. And what you see is they just recently did an $88 million Series C at a $426 million valuation, right? So on the count of 3, you guys tell me what multiple they were trading at. Do the math real quick. 426 million valuation, 25 million in ARR. I'll give you 5 seconds to think about that math. 426 divided by 25 on the count of 3. What's the multiple? 1, 2, 3. Well, a very strong math group here today. Holy shit. We got work to do on that. All right. Let me just put it this way, right? Not necessarily a great multiple. So this is trading at, Cognism is trading at 17x on the left. The left side is the left side is Europe, right? As a comp. The other side is the US in the form of Gong. Now, the only difference between these two companies, NDR, ARPU, go-to-market sales motion, B2B, everything is basically equal. Revenue growth rates is basically equal, except that second bullet point under Gong, right? Which is Gong's, when they did that round, it was about $120 million ARR is where they were at. So again, you have in the EU, Cognism traded at 17x, Gong's trading at 60x. So like, how's it make you guys feel? Yeah, the guy back there said that. Are you running a company right now? Did you just raise? What, you didn't raise? What's your company name?
It's Hip Hop.
Hip call?
Yes, it's a fresh company. We are just
We love fresh companies. When you say fresh company, I'm going, okay, the Freshworks bought you. No, it's just it's a brand new company. Well, we're rooting. You're in the right spot. We're rooting for you. All right. What's the URL? People can give you some love.
hipcall.co.uk.
Okay, say that one more time.
hipcall.co.uk.
.co.uk. There you go. Support a fellow SaaStock Localer over there. All right. So a couple points on this. The one premium you're seeing in Gong, and this is a good note for anybody, is you just get a valuation premium once you're above $100 million in revenue. It's sort of like the same thing that happens once you're above 10 million, right? You just get premiums because you've de-risked the business. There's clear product market fit. There's clear go-to-motion, right? But again, everything else is equal. So why aren't they sort of trading in the same? Let's just put it this way. I think you'll see Cognism sort of raise a double or triple that valuation sort of end of this year, even if it's in the form of a secondary. So unfortunately, I don't have good news for you here. I'm just telling you it's not fair. And that's all I got, thanks. I'm just telling you it's not fair, right? So I don't know what the solution is, but it's not equal currently. What I would say, try and make yourself look like an American company, right? Open up one of those fake postal boxes in New York right on Broadway. You guys are shaking. You know what I'm talking about. That's what you want to do. Broadway is the best spot, okay? So it's not fair. Okay, let's go down to the second one, which is multiples are polarized. I don't have slides on this one, but I just want you guys to understand, right? A valuation that a VC is going to pay, ideally, you're pitching your vision to them and they're looking at your history and saying, I believe Guy at Epsta, because he can execute, I'm willing to pay as if he already has the growth in the future. That's the VC valuation. That's going to be the highest valuation you're going to get. Right? The middle valuation is going to be private equity firms like Mainsail, right, doing either majority or minority buyouts. Right? So they're buying 40 to 60% of the business. They're going to be at a valuation discount of something like 30% to the VC one. The cheapest ones are going to be your acquisition offers, where it's all cash up front. Right? Obviously, that's a lot of risk for the buyer. They're paying, it's great for you, right, if it's good valuation, but that'll be at almost like a 60% discount to the VC valuation, right? Those used to be tighter. So when I say multiples are polarizing, that's what I mean when I say it's a larger gap. Why is that important for founders? You just got to know what game you're playing. You just gotta know what game you're playing, all right? So if you're bootstrapped, you just gotta know what game you're playing. If you're on the VC path, know that game as well. There's a really good example of this, obviously, at Hopin, right? When he can go raise at 100x multiples, and StreamYard is doing 30 million bootstrapped in ARR, and he can buy them for a 20x multiple, and it's doing 30 million ARR, how much did he just add to his valuation? I can't do that math that quick either, but you guys do it with pens and paper, right? There's an 80x arbitrage there. All right, this is called just multiple arbitrage. You only used to see this in publicly traded SaaS companies, where they'd go buy companies at cheaper than whatever they were trading at, their PE ratios, right? You're now seeing this a lot in private markets because there's so much money available. So if you're in a fortunate position where you can tell a great story, you have a great tool, and you can raise at a 20, 30, 40, 50x, you should go and be very aggressive on the M&A side if you can buy at 2, 3, 4, 5, 6x. How many of you guys have bought a SaaS company before? Either you're the founder and you bought a company, or you're part of a team that bought another company. Just raise your hand. Okay. Did you play any arbitrage games?
No.
No? None at all? So you lost money on the deal?
Yeah.
Okay, that's a shitty example. What about this guy? I'm just kidding. This guy's building some very cool Lime Chat, right? Lime Call. Limecall.com?
Yeah.
There you go. See, I give you free exposure. Now you don't hate me. Limecall.com, check it out. What company did you buy?
Don't put me on the spot.
Okay, I won't put you on the spot. These are basic. I'm not asking for your cap table. All right. Was it recently?
No.
Oh, it was a while ago. Okay, you bought one recently?
Yeah, we bought a CRM company, but it was insolvent.
CRM company insolvent. Sounds like blood in the water. Hopefully you paid like nothing for it and now it's making millions.
Pretty much.
Really? What's your name?
Mania.
Mania. What's your company name?
It was a previous role last year at Phoenix.
At Phoenix.
Automation for real estate.
Market automation for real estate. Very cool. Well, congrats on that. Yeah, so places to look if you want to do this M&A stuff, Google App Exchange. Go look at apps that have been downloaded a ton but are free. It's usually a sole developer in their basement that hasn't updated in a year. You can go buy a big user list. Google, Salesforce does this in their App Exchange. Zoom does this in their App Exchange. Look where the code hasn't been updated in a long time, but there's a lot of free downloads. Right? It's a great way to buy companies for cheap, cross-sell, and grow really quick. That's on page 173 in the book, Buying Chrome Extensions. Did you like that section? He goes like, oh yeah. What's on page 243?
11 and 10.
Okay, and halfway down the page, there's a highlighted section. Read it out loud. This is storybook time. Yell it.
One of the biggest mistakes of my life.
No, read the yellow highlight. Come on, Hugo. The yellow highlight in the LOI. It's about halfway down the LOI.
The purchase price will be up to 6.5 million
It's just how is it distributed?
and will be paid in the following manner.
Come on, Hugo.
So you want to
Yeah, keep going. Oh, he took his glasses off.
total potential cap consideration will be calculated by multiplying the sum of the seller's September 2011 up.
Okay, I'll help out, Hugo. It was, but that's what I wanted, right? So point being is this. Remember that cap table I showed you when we raised it at 10.5 post? I still own 38%. That offer came in 2 months after we raised. Yes or no, could I sell for 6.5 million? Hold on, you have to get this. Think about it. I'm gonna say it one more time, then do it again. We raised 2 million on an 8.5 pre, so 10.5 post. After we raised it at 10.5 post, we got an LOI for 6.5 million bucks. Yes or no on the count of three, can I sell for that? 1, 2, 3. You can't, right? I would have loved to do it as a 21-year-old, 38%, 6.5 million. 2.3 pre-tax, depending on if I'm in Puerto Rico or not, I'm paying about $1 million in taxes, right? So million something, 21, you would have done that deal. You can't do it. You lose optionality when you raise. That's what I mean when I say you got to know the game you're playing. There's nothing wrong with being a bootstrap founder with 2 or 3 million bucks in revenue because you have all options on the table. There's also nothing wrong with raising. You're just playing a much different game and you just got to know the game. Use secondaries in that case. But back to where we are now. That's what I mean when I say multiples are polarized. All right, that was first section. How are we feeling? Was that good? Yeah, good. Some good data? Any questions on that? Should we wait till the end for questions or should we do questions like as we go?
We were going to do it at the end, but it's entirely up to you.
Okay, let's do questions. Any questions on those first 2 things? Right, so unfair European versus American valuations and polarized multiples. Any questions? Okay, yeah, hit me back here.
What advice would you give to British founders who were...
You have to yell.
What 3 minutes of advice would you give to British founders or European founders if you were going through the raising process, other than setting up the
PO box? It is a good tactic and it's cheap. It's like $20 a month. Yeah. So the question is, what advice would I give a European founder who's looking to raise and wants to get a US valuation, not a European one? You ideally have 1 or 2 folks in the US already. Right? You could acquire your way there, acquire a small company, 1 or 2 people to get your way there. You just basically have to be able to point to something you've done in the last 2 months that shows you are serious about US expansion. Okay. That's what I would recommend. Has anyone done this really well? You feel like you're a European company, you raised and you got a US valuation? Did you think you did it?
Almost.
All right, talk a little bit about it. Guy Rubin, do we have a mic up here? Okay, Guy, it'll come around. So this is Guy Rubin with Ebsta, EBSTA.com. Go ahead, guys. So you feel like you did this. Where are you based?
We're based around the corner in Old Street. So,
okay.
But we have a small team in California, and we made a big deal about our US team. 70% of our customers are in North America, so we reset up a US office to service those customers. We were customers of Founderpath, so I've known Nathan now for the last year or so, and really helped us to have enough capital in the bank so that when we were raising, it didn't look too desperate. Yeah. So that was a big component of getting the raise over the line in December.
Are you comfortable sharing how much you took from Founderpath?
Yes.
He doesn't remember.
I don't have the exact numbers.
Can I share?
Please do.
It was $350. So what did that do when you sent your balance sheet over to the VCs?
In fact, you offered us a lot more than that. We could draw down up to $1 million at the time, but having the 350 on the balance sheet, it just meant that we didn't look like we needed access to the capital quickly, and actually it sped up the raise. It sped up the raise a lot. And in fact, got us a higher valuation in the end. But don't tell Nathan.
Yeah, and we can talk more about like other tactics to use where you don't use Founderpath. But again, anywhere where you can say like the California office obviously is a great option. Just anything to point to traction in the States. So yeah, thanks for that, Guy. Okay, any other questions here? Okay, go ahead.
That's a good one. On your spread.
Here's the mic. Yeah.
You kind of use the run rate, the ARR run rate as a proxy for kind of when the spread is kind of fundamentally split. Is there anything else that's kind of influencing that? For example, if you're raising as a cybersecurity asset, would that actually be irrelevant in terms of the actual spread between the valuations, whether you're in the EU or whether you're in the US? Mm-hmm. Or if you're in like marketing automation, then it's definitely going to be like 10x versus 60x, but
Yeah.
if you're doing cyber, it doesn't matter.
Yeah. You guys ever see people that put out reports and it's like a bunch of averages on stuff and you're like, what the hell does this data mean? And who are the companies behind these averages? This is one of the things I don't have data on because I don't know how to attach a taxonomy to all the interviews. Some people, I'd say they're a CRM, but they'd say we're a revenue acceleration tool. And I'm going to be like, okay, you pick up trash or you're like a waste manager. It's like this. By the way, nothing against CRM. Sorry, that wasn't an analog to CRMs. But the point being, I don't have data on that. What I can tell you is everything you're looking at here is B2B SaaS. But I don't have the split between a marketing B2B SaaS versus cybersecurity. Yeah. All right, let's move on. We can get other questions on the end. The second section here, that first data point will surprise you. Most founders don't realize this. If you're growing revenue 100%, right, year over year, but your net dollar retention is only 95%, which is actually still pretty good, but 95%, you're going to get dinged. It's more important to have a higher NDR than it is to have a high revenue growth rate. Can anyone explain that? It's more important to have a high NDR than it is to have a higher, hit me.
Well, yeah, it costs a lot of money to acquire new customers, but retaining them, if you manage to retain them, then that's money in the bank, right?
Yeah, exactly. The question, like the thing to take back to your strategy teams tomorrow, what's today, Monday? Tuesday. Today's Tuesday? The thing to talk about tomorrow with your team or put in the Slack channel tonight is, hey guys, if we don't add any new customers this next year and we want to grow 30%, what can we sell? That's the question. No new customers, what can you sell? Can you sell something for $1 million if you go really deep with 2 customers? That's the question though. So just tell your team, disaster struck, no new customers. How do we grow this year? We can only upsell, and you'll come across some cool things. The second thing, these are the 2 biggest moats I'm seeing at the highest valued SaaS companies right now. Can you guys read those? The 2 moats in bold there, the second point. Yeah. Does it surprise anybody or does that make sense? Any surprises? We'll dive into them here in a second. So let's jump in. All right, let's talk about NDR first. Now, I don't know if this is big enough. This is one of those things you probably want to take a screenshot of, and you can feel free to take pictures of anything in this deck. Actually, you can sort of see that, right? So what you're seeing here is on the left side, these are companies with less than 115% net dollar retention. The 2 examples I'm using are Lemlist, right, and Security Scorecard. Right, so Lemlist had an offer of 10 million on a 150, sorry, they were doing 10 million in ARR. They did a secondary at 150 million, right? So they're trading at about 15x. Security Scorecard has 71 million bucks in ARR, trading at $1 billion for 11.3x multiple. Again, low NDRs, they're trading to 10 to 20x multiples. Go over to that middle column, study that data for a second. Look at the multiples, and then look at the range across the bottom. Right, so these are anything above 130%. Sorry, between 115 and 130% NDR. Your multiples here are 20 to 40x. The comps I'm using here are 2 recent ones with CoreLogics, which is cybersecurity, well, kind of cybersecurity, and G2, which you guys probably know, right? 50, he's actually up now to 62 million in ARR. Told me that on Monday, but 50 million G2 ARR traded at 1.1 billion valuation for a 20x multiple. And then that sweet spot, again, if you care about valuation, I'm not saying you should, but if you are and you're playing that game, that right column is where you want to be, right? Where you've got Gong trading at like a 60x, right, and ClickUp trading at a 50x, 50x. They both have higher than 130% net dollar retention. Does anyone in here have really strong net dollar retention, like above 100 even? Oh, I know some of you guys do. Yeah, you guys must be co-founders because you looked at each other. Oh.
It's a compliment, but no.
Why'd you guys look at each other?
We work together.
Oh, but you're not co-founders.
Business development, customer success.
So if I ask you your NDR, like I probably shouldn't do that because it gets you in trouble. What's your NDR?
We're pushing for 125.
Yeah.
120, that's good. Keep that job. You get options when you signed? You get a little stake? Yeah. Okay, I'm picking up what you're putting down. That's good stuff. That's great. And so why do you think you have such a high NDR? Well, like what product are you upselling and what's the price point?
Product, service.
Oh, you're upselling services?
Well, no, we're product for client success.
Interesting. Okay, so here's the
Really big on our customer success.
Okay, so here's a question for this, and I can give you data on this because I just did it the other day. Everyone think about this for your company. What percent of your year 1 ACV do you add on as professional services?
Good point.
So if you sell a $10,000 a year contract, but you sell a $1,000 setup fee, it's 10%. What's everyone's number? Does anyone have numbers there?
It's like 6
People are trying to do the math.
I can't do math.
It's okay.
With me, so
It's okay. Okay. Well, I can tell you, most people think you shouldn't do this because VCs say we hate professional services margin, right? How many of you guys have heard that, right? No services, no services. You know what? If you look at the cohort you've touched with services and the cohort you've done no services on, that services cohort's gonna have a way higher net dollar retention. So like invest in services, just charge enough, right? That's the key. Most SaaS founders, we just did a big study on this, most SaaS founders are charging about 25 to 35% of year one ACV on setup. Professional services. So just keep that in mind. All right, so that's 130%. So let's dive a little bit deeper into this. Okay, this is from category 1, low multiple, right? Less than 115% net dollar retention. This is Alex with security scorecard.
So we're going to finish this year with about, anywhere from 70 to 73 million annual recurring revenue. We're growing very rapidly. Our net retention is solid, right? Our net retention, our net retention is hovering between 115 to 120%. I want to increase it by about 10 points even further and get it into 125 to 130.
So he's at 71 million bucks in ARR and really wants to file his S1 in Q3. He cannot file with 120% NDR. The markets will hate it. You've got to be up in the 130 to 140 range. So again, look for an S1 from him, but I think it's probably Q4 or Q1 2023 with security scorecard. All right. Let's go now to a familiar face. This is 2018. Your very own. Give it up for Christian Owens.
So revenue trends actually, so we see on average, if we aggregate all of the customers, we see about 25 to 35% growth in underlying business each year. We were to stop all sales, marketing, everything today with the 900 customers that we have, top line revenue would grow roughly 30%.
Where the hell is he, by the way? This office is much cooler. This is where is this? Is it like a hostel somewhere? No, we're not sure.
Dark days.
These are the dark. Oh, he is here. I'm in so much trouble. Oh, shit. None of you spoke up. None of you. I could feel something in the room and I'm going, he's here somewhere. Where is he? Where is he? Dude, this was back in isn't that crazy? 900 customers in 2018. You've come, it's like crazy. What's revenue today? No, just kidding, Christian. I'm just kidding. But okay, so what he just shared, this is sort of weird. I've never had a situation where I'm playing the video, but it's better to just sort of ask the person. But what he just shared with you is the question I just asked you. If you add no new customers, what do you grow by? And for Christian in 2018, that was 30%. What is that? Can you share that today? If no new customers, what would you grow by? 40. Yeah, crazy good. Assuming churns low, right? 120, 130, 140% NDR, right? And so he's also going to kill me for this. Oh God. This is Paddle's revenue growth based off some data points. It's accurate. It's accurate. I'm reading his face. It's accurate. So breaking sort of the million mark in 2014, 2015, right? Continuing to scale up to about 26 million in terms of ARR at the end of 2020, and then scaling nicely. The reason I'm showing you guys all of this is because you can read that headline. Now, I have no inside information here. I have no idea what the valuation was, Christian, on your last raise, but I bet it was way lower than it should have been. I'm not sure it was above 1.7 billion. What I would say though is I think if the same company existed in the US, it'd be trading at 2.5, 3 billion, right? 2.5 or 3 billion. And the reason I say that is because we just heard 130% NDR, right? So assume 10% churn, 40% expansion, 130% NDR. That puts him in the Gong sort of ClickUp territory. So not maybe 50x, but 40x, right? 40x against 50 million, you guys do the math. Right, that's what it should have been. And by the way, maybe it is. Maybe it was higher than that. He's trying very hard not to play poker. He's playing poker with me right now. All right. So anyways, I want to show that example with you. And then lastly, all the way in the right column, which is NDR above 140%, you've got folks like Amit at Gong, right? So here's Amit talking about that.
Yeah, so our NDR is almost always these days north of 100%. And
115 or 150?
150.
Don't you love COVID? You guys see me? That's like pajamas, still in boxers, in like a friend's apartment in LA. Oh, and it's like a meet, $7 billion. This is fantastic, right? But story there again, revenue growth slowing down because you're playing with bigger numbers, right? So going from 120 million in ARR to sort of 140 million in ARR. But again, net dollar retention, super high. That's why obviously last raise trading at 60, 70x sort of premium there. So those are sort of the three categories. Again, that's the question you want to ask your teams in Slack tonight, tomorrow, whenever. The big takeaway sort of from this middle section. Before we move forward, any questions on net dollar retention? Hey, yeah, okay, hit me. Yeah, go ahead.
Yeah, is that annual?
Yes, annual. Yeah. All these are all annual numbers. Yeah. Christian, anything you want to add on net dollar retention?
It's important.
Yeah, go ahead.
Got a question. Usage-based pricing, obviously, kind of predictability is a challenge, and therefore, relying on your NDR as a valuation is going to be ever more tricky as it becomes a more increasing trend among SaaS businesses. How would you try and reconcile that?
How many of you guys have some portion, if you look at your pricing page, there's something that's usage-based upselling? Number of seats, amount of cloud storage, number of contacts, raise your hands high, just out of curiosity. So by the way, like the word SaaS probably won't exist in 3 years because it's all moving towards usage-based pricing, which effectively is SaaS. The thing with SaaS is all of if you open your customer list right now, you've got a bunch of those customers that pay you a lot that haven't logged in a year, and you're like, shit, do I email them or not? You don't want to email them to reactivate because then they might ask to cancel, but you're like, I really should activate these people. Usage-based selling, there is none of that. If they use it, they're paying. And you don't have to look past Snowflake's IPO to understand the power of usage-based upselling. Right? There's Snowflake, in my opinion, is not SaaS. It's almost pure usage-based upselling. So usage-based is the future of pricing. And frankly, the higher NDR companies are usually usage-based. Most of the problem that I see for this is people think that people are paying for them for one kind of usage, and it's actually something else. And so the trick is to make sure you really understand what that usage-based is thing that you should center on. For cloud companies, it's pretty easy, right? Usually it's like storage or number of servers. For CRM stuff, it's pretty straightforward too. It's usually like number of contacts, number of email sent, something like that. For everyone else, it gets a bit tricky. Is anyone pricing against something strange? Or something maybe like not normal? You feel like it's not normal? Percent of GMV is a good one. 5%, not too high, just about right. No one from Paddle's making eye contact with me. 5%, right? That's great, because then you just say, get more GMV on the platform, help our customers grow, right? So, okay, that's the answer there. We'll come back to some of those questions. Let's talk about, how's everyone feeling though, energy-wise? We good? All right. Christian tells me you can drink all the drinks back there in the back. You want some energy drinks, anything like that, you just go to town. All right, these are moats. Okay, so we're gonna talk about two moats. The first is instant CAC payback. Before I go into that moat, let me just ask you guys, I'm gonna ask you to yell out a number here on the count of 3, and the number I want you to yell out is your LTV to CAC ratio. Okay? 1, 2, 3. What the bro, Alex, come on. Okay, think of LTV to CAC ratio. So you might say 7 or 3. If you don't know, make it up so I don't look stupid. On the count of 3, what's your LTV to CAC ratio? 1, 2, 3. Wow, guys. Whoa. All right. Okay. This totally ruins how I was going to sort of take this. Most people would say, I want an LTV to CAC of 5. I have so many founders, big founders, come on the show and brag about their LTV to CAC being 5. Why might not that be good? When is LTV to CAC of 5 bad? Just think about it. Any guesses? It's like those damn SAT questions where you're like, these people just want to trick me. Yeah, okay. When LTV to CAC 5 is bad?
You've got a really long lifetime, I guess.
If you've got a really long lifetime. And so why is that?
Because then it's going to take ages to pay it back.
Take ages to pay it back, exactly, right? So what people always say is they're very proud. They say our churn is 1% a month, right? And I say, what's your lifetime value? And they say some massive number, because what they're doing is they're taking their ARPU, $30 a month. They're doing 1 divided by churn, so 1 divided by 0.01 to get 100 months of LTV. Right? Times $30 a month, they're saying $3,000 LTV. We spend $1,000 to sign the customer up. Right? We have a 3x LTV to CAC ratio. It's fantastic. Well, no, because it takes forever to get the money back. What you want to optimize for is money velocity. how quick can you put it back and how quick can you get it back? Put it out, get it back. This is instant payback CAC period. All right, let's talk about that first. In my opinion, I searched long and high for the company I think is doing this the best in the world. And I think it's these guys at ClickFunnels. Raise your hand if you've heard of ClickFunnels before. Okay, many of you guys, you probably already know this, but let's listen into Todd and Russell here, the founders of ClickFunnels.
Do you guys measure payback period, like time to recover cash?
Not really. Our all-in cost to acquire customers is about $130 at this point. But like Russell said, we don't really even look at it that way because that upfront media spend that last month was about $130. So with that upfront media spend, that was really paid back to us immediately through these front-end one-time products that are being sold. So we're acquiring the ClickFunnels customers, but really the upfront net is effectively zero.
All right, the upfront net is effectively zero. So let's brainstorm real quick because this is where a lot of people get stuck. They go, Nathan, I'm a B2B SaaS company. What the hell do I sell at the top of my funnel? So let's just brainstorm together. I'll get the ball going and then you guys yell things out. The question is, what can you put at the top of your B2B SaaS funnel to recover your LinkedIn marketing spend quickly? All right, so what does Russell do? He downloads all of his podcast episodes, puts them on a USB drive, and sells that for $30 plus $20 shipping. I don't know how it costs $20 to ship. Probably just a way to expand the cart value on the initial checkout, but it works. So that's $50. So USB drives and podcast audios. Help me out here. Reports, PDFs. What else? Courses. Diagnostics, an initial test, HubSpot's website grader sort of deal. What else? Audits, fantastic. Yeah, anyone else? We're brainstorming together here so you guys can sort of think about your own things, put at the top of the funnel. Conferences, conference tickets. Trying to think, what else? Books, right? Books, magazines. Magazines are great. Right? So does everyone understand that instant CAC? But you have to put something on the top of your funnel to get your money back first, then upsell the software. It's very, very, very effective this way. That increases your money velocity. Okay? The second thing is community. Now, a lot of people say like community is really important and you sort of think like Guillaume at Lemlist and sort of his Facebook group, which is a really good example, but it's very hard work. You know, he's posting a video per day for years, right? Or you're like, oh my God, you know, my HubSpot email marketing, I have like 100 subscribers finally, and it's like really difficult. Like, so what's a way to sort of jumpstart your community? I think this is genius. I think all of you guys should replicate what 90 did. Okay, this is 90.io if you want to check them out. Let me show you what they did. They bootstrapped to $5 million in revenue. Here's his revenue growth chart. All right, so I'll let you look at the growth, but look at that bottom line. Look at that bottom line. All right, if you can feel free to stand up if you can't see it, but look at that bottom line. All right, so that's the conversion rate of free users to paid customers. Many would look at this and say it's very high. Most freemium tools, you're seeing like 3, 4, 5% convert to paid. Well, why is there so high and how could they bootstrap to $5 million in 3.5, 4 years? Here's what they did. See that book? It's a brilliant book. It's in the category of Rockefeller Habits. Actually, even Jeffrey Moore's Crossing the Chasm, sort of these playbooks of how to run and sort of systematize your OKRs. When they saw the book doing well, they reached out to the book author and said, can we license the rights to the name and we're going to build software for people to operationalize your book? Made the author feel great. It's like, how do you duplicate this? You go into Amazon right now, you go find the book category closely associated to your brand or your B2B SaaS company. You see who the top sellers are that don't have a software company, which by the way, most of them won't. Book authors don't code. And you reach out and ask to license and you make them your celebrity. It's a great way to jumpstart community. And again, it worked fantastic. So the economics behind this licensing deal between 90 and Gino at Traction is they pay a certain percent of their monthly recurring revenue out as a flat fee. Right? So right now, that their coaches sign up as a flat fee. So any coaches of Traction who drive signups, they pay a flat fee back as a kicker. That cost today, right, at about an $8 million run rate is about $100K per month or 1.2 annually. Right, so it's something like 18% of their total revenue is spent on this licensing deal, but it jumpstarted their business. They bootstrap. So this is one of those tactics where you might look at it and go, I don't know that I could replicate that. You might also go, okay, that's genius. I can definitely replicate that. Raise your hand if you're you feel like you can replicate that strategy. Okay, it's okay.
Connection between the software and the book.
The licensing deal. That's it. So all the founders, anyone who's read this book, you can sign up as a coach to teach Traction, and they're all taught to upsell 90. But none of those coaches sit on the balance sheet or the P&L statement of 90. There's no SDRs, no BDRs. It's all offset via this licensing deal. Yeah. So if you feel like it's one of those things that you can't replicate, I would just encourage you to go into Amazon and you will just be surprised. Go look up your category, find the top books, and just think, is there a way I could license the rights to this specific book with this author, right? Okay. Again, they scaled nicely. So then they got this email. About 16 months ago, right? Now, that might be big enough for you guys to sort of scan, right? But this is your traditional, I'm a big VC, I want to reach out, right? This is Insights Investment Team. This is the first email to 90. Nothing too crazy. This is pretty boilerplate stuff, but you'll see they sort of mention a competitor, I guess, in Monday.com, blah, blah, blah. Long story short is they ended up raising $20 million. He asked me not to share valuation, which I'm going to respect and not share, but they raised $20 million at, let's just say, a very healthy valuation, right? Through using community sort of as that moat. There's a lot of ways to use community as moat. You don't have to look past Hustle going to HubSpot or Indie Hackers going to Stripe, or Morning Brew going to, I forget who brought Morning Brew, but you know what I'm talking about. Right? There's very limited media brands out there, so it's a very smart strategy to go acquire media brands in your space or content plays if they exist. You definitely want to go do that. So those are the two things here, two key metrics. Again, optimize for instant CAC payback period, higher NDR if you're optimizing for valuation. Any questions on those? We'll save them to the end. We've got about 10 more minutes left. Is that okay?
Yeah, sure.
Okay. You guys want 10 more minutes? Yeah. Okay, we can go right to questions too, and I can quickly go through the slides. All right, these are the last two, right? These are just things I listen to over and over that I hear really smart founders do that I wish all founders did, that frankly I wish I did at my first SaaS company, right? The first is secondaries, and the second is threaten a bridge round. There's no VCs in here, so that doesn't get any laughs, but it will in a second. Who can describe what a secondary is? Is anyone? Come on, she's being shy again. You're smiling. What is a secondary? Come on, yell it out. She's like, no, okay, fine. All right, we'll talk about a secondary here in a second. I'm actually not going to talk about it. So again, Alex and their team do a great job of bringing in sort of the top founders in the world to be in the SaaStock ecosystem. Henry Schuck has been on many times, and one of the things that Henry will tell you that he doesn't talk about a ton is he is very capital efficient. What I mean by that is you'd think he's just a guy raising a lot of capital playing valuation, but he also got really, really rich through some very specific terms that he shared, right? I have the LOI, so I'm gonna let you read these yellow highlights right here, right? As he's growing the business, right now it's 2011 to 2014, he's sort of crossing $10 million in revenue. Right now, today, obviously, they're publicly traded as ZoomInfo, right? Almost $500 million in ARR. But let's go back, right? 2011 to 2014, 5 million going up to 10 million in revenue. He gets this. Oh, that's obviously not legible. He gets this though in his inbox. Let me blow it up. Right? He gets this in his inbox. Now that might be legible. I'll read it in case it's not. This is the actual letter of intent, which again, I've got permission from him to share. Right? And what this says is blank, so it's an investor, right? Blank will invest 35.5 million of equity to purchase 70% of the fully diluted units of, in this time it was Discover.org, right? Now, in addition to that, there was additional 6 million, right, in debt funds, right? So another 6 million in debt, so over 40 million. But look at that use of proceeds slide right under that. Look how the money is going to be used, right? So what that says is 40 million will be used to repurchase units held by Henry and his co-founder Kirk, right? 40 million repurchased. So effectively the entire round was a secondary. What a secondary is you guys selling your shares and cashing out. It's effectively an exit, but then you keep equity, right? You can double, triple, quadruple dip. Henry's quadruple dipped. He did 3 secondaries pre-IPO, then sold shares in the IPO, right? Four dips. Here's the trend. You're seeing secondaries happen earlier and earlier and earlier. You just have to have the confidence to ask for it. And you got to be able to say it with a straight face. I know you're giggling. This is the hardest part. You got to be able to ask for it. Many founders feel like I'm too early. I don't deserve this yet. Just look in the freaking mirror with a straight face. Go, I fucking deserve it. I'm asking for, just say, when you're negotiating the email, say a portion of the round will be dedicated to a secondary, of which we will determine what percent of the round will be used for share repurchases later on. Just set the anchor that a portion of the round will be secondary and then negotiate how much of the round will be secondary, 10, 20, 50%. You should also, when you do this, set a price and allow early employees to also cash out, right? So if they're gonna stick with you for a 10-year journey to IPO, they can also cash out along the way, right? Which is important. So that's how to structure a secondary. Now, the reason I'm putting this slide up now, that LOI in Word doc form, if you want to copy it and use it yourself, you can get at this URL. So what this thing is going to take you to, if you point your phone's camera at it, and you're only do this if you're liking the content so far, because I'm asking for reviews. So if you hate this, don't leave a review. I'll give you the deck for free, right? If you love it, leave this review. And all you have to do after you leave the review is just email me, Nathan@founderpath.com, with a subject line London. And I'll send you the LOI, I'll send you the docs, I'll send you the slide deck right away. I mean, not literally now, but tonight before I go to bed, okay? All right, let's move on to this last section here. So talking again about valuations. Now, does anyone know Supermetrics here? Okay, great. Like, crazy, great story, unbelievable story. I don't know how many of you followed it, but basically, Mikkel was flat, like super flat for a long period of time. I'll show you his revenue in a second, but listen to hear how he describes this raise that he did, the most recent one, 40 million raise at a $400 million valuation with about 37 million in ARR, so about a 10x multiple.
He starts in 2010. He bootstraps. He has a great mousetrap with Google Sheets. He's past 12 million in revenue. This is great. And then I get news this year, he'll raise us 40 million bucks. What changed? Where was the breaking point where I said, you know what? I should go down the VC route for this thing. Let's go raise capital.
Well, our numbers have been pretty awesome lately, as you know, and there was a lot of inbound interest from VCs, top names from all over the world. So I just figured it's probably a good time to raise some money. So that was the reason why I started thinking about that. And to be honest, part of that was secondary, so I also sold some shares.
There we go. That's why you would sell at a valuation that's not 40x, right? That's why you would feel very good raising at a 10x, right? So that obviously a large portion of that round went to the founders selling shares and early employees also selling shares, even though the valuation wasn't optimized as high as it could possibly be. But again, when you look at Supermetrics revenue, you can see fairly flat through 2018. And then Google reached out and said, Mikkel, we really want you to be one of our initial apps launches, right? With the Google Suite, link into the Google Sheets, et cetera. He did that. And obviously growth is now taking off. Obviously, I think, this Mikkel has a very short path to being $4, $5, $6 billion sort of valuation company. We'll see what happens though. All right, and again, that happened just last year, sort of in August of 2020, doing that round. Right, so that's secondary. The second thing I want to talk about is threatening a bridge round. Now, who knows what I mean when I say this? Has anyone done this before? Threatened a bridge round? No, no one wants to shake their head because they know I'm going to be like, hit me. No, you're smiling. No, bridge round? Bridge round, no bridge rounds? Okay. A bridge round means this. You're sending your updates to your advisors and your VCs. They're saying, burn faster, hire faster, because the faster you run out of money, the faster you got to go back to them, right? And then they have you buy the you know what, right? So what you can do to counter that is threaten a bridge round, right? And the nice thing about threatening a bridge round is it gives you the power back as the founder. Number one, you obviously don't let burn get out of control, right? But if you do need to reset, you can threaten a bridge round. And what I mean by threatening a bridge round, right, is this. This is sort of what it means. This is sort of like the definition of a bridge round, right? You're buying runway, right, by getting extra cash. Now, the way you get that cash is your call. You could go raise from an angel, right, at a down round, a small amount though. You could raise debt, right? There's a lot of options to sort of do a bridge round. So let me just jump into a bunch of different ways to do this. Now, what you're seeing here is how we did it with Guy at Upstead, Founderpath, right? When you connect your Paddle account, you see all your customers listed, right? And you basically just select all your customers, and as you select them, we'll give you an offer on the right side, right? So you could take up to 6x of whatever your MRR is right now. If you're doing 100K in MRR, you can take 600K. That could be a bridge round. That gives you 6 more months of runway. Or what Guy did, which is really smart, is you put it on your balance sheet in the form of cash before you send the data room over to the VCs. So you look way healthier. I mean, you already were healthy, but you look even healthier, right? Like you really don't need them in that data room. And then you just pay it back in 3 months, right? With no penalties or anything, right? Because you don't obviously want to pay interest on debt that you don't need, right? So once your Paddle account is connected, you're selecting customers, you're turning into upfront cash, right? You're sort of seeing here how many customers are selected, the selected MRR, the total contract value, and then we're effectively putting dollars out at a discount rate. We're buying future revenue from you at a discount today. And so that's sort of how that works. And it's very quick. I don't know if you remember for you what it was, but maybe a week, 2 weeks?
It was less than that.
Less than that. Yeah.
We'd had some conversations to start with, but we were drawing down the money within the first week.
Mm-hmm. So Founderpath is not the only solution for this. There's a lot. Pipe, CapChase. If you're an e-commerce brand over here in the States, there's in the UK, there's Uncapped for e-commerce brands. A lot of people doing this. You also don't have to use debt. You can use equity. There are plenty of other, you can use bank debt. You can use SBA loans. You can use grants. There's all kinds of ways to sort of do bridge rounds, but threatening it is important. And now the main reason people don't use debt for bridge rounds is it's really hard to pay off early without big penalties. We hate it when founders do this, but it's important for the flexibility, right? I was trying to get guided. Did I not try so hard to get you guys to keep the money?
We did try.
I tried so hard. I couldn't make it happen. So we paid it off, whatever, we're still friends, right? So that's sort of how that worked. You just sort of heard Guy's story. But that's sort of how we're doing. If you want to do that same thing that you just saw happen, you just take a picture of this. You can do it later. But if you scan this, you'll very quickly see how much capital you could get for your SaaS business. Obviously, you want to be the CFO or the founder of the business to do that. But here are a bunch of other options that I think is important for everyone to understand in terms of capital options today, right? There's 6 very specific options. The first is equity. Now, on the left column, what you're seeing is the cost. Now, obviously, I'm assigning a 40% cost capital to equity. It's really hard to assign a cost capital to equity because you have to have some future event where there's liquidity, right? So you're just sort of guessing, right? But generally, equity is going to be your most expensive. Why? Because you don't have to pay it back. Super flexible. That's your second most expensive cost to capital, right? These are for early stage founders. You're going to be doing a SAFE, right? A SAFE usually does have an interest rate of 8% convertible note, right? And you're also trading that at a 20% discount to the next round, right? So those will be your SAFEs. Seals are not popular over here yet. They're barely popular in the States, but it is an option in between. What a seal is, it's a shared earnings income agreement. And all it means is you can get $1 million today, you wait 12 months, and you start paying it back. There's a cap, so you pay back 3x. It's called the repayment cap, 3x, the $1 million, and you can buy back up to 60% of the initial equity you sold. So if you sold 10% equity, you can buy back 6% for 3x whatever you raised. Shared earnings income agreement is called a seal, right? Under a seal, it's called revenue-based financing. Has anyone raised an RBF before? I can teach it. Anyone, RBF? All an RBF is you raise capital and you pay it back over usually a year to 2 years as a percent of your monthly receipts. So 5 to 10% of your monthly receipts. The challenge with that is if you grow really fast, you pay it back in 6 months, the effective cost of capital is like 40, 50, 60%. Which is weird. You want it to be cheaper for fast-growing companies. You don't want to penalize fast-growing companies, right? That's why this doesn't make any sense. But that's how an RBF works. Under an RBF are traditional term loans. Someone help me out over here in the UK. Who's the bank that is being most aggressive doing term loans into SaaS companies? It can't be the Bank of England.
SVB.
Who?
SVB.
Is SVB big over here? Pretty big?
Yeah.
All right. So SVB maybe is the guy. Who else? Did you look at the market over here?
Silicon Valley.
Silicon Valley Bank is the big one. Okay, cool. Yeah, so that deal is obviously going to be sort of term loans. And actually, so SVB is actually going to sort of be down here, right? They're going to be like bank debt, right? 4% in the States, SOFR plus 500 points, usually so a blended cost of like 6 to 10%. But term loans are just above bank debt. And the reason a term loan is above bank debt is sometimes term loans are unsecured, meaning they can't take over your company if you default. Bank debt is usually much tighter secured. It's more protected, so they can give it to you cheaper. Where we're trying to play is sort of right in the middle here, right? That's sort of where Founderpath is playing. We're above bank, we're more expensive than bank debt, right? But cheaper than seals, safes, and equity, usually. Again, if you want to see how much you can get, you can just sort of use that QR code. But the point that I want to put on the slide is you guys have more options today than ever in terms of how you raise capital. Just know your options and be super, super creative, okay? All right, so wrapping up in summary, I don't know how long that was. It was supposed to go 29 minutes. Hopefully I was sort of close. How did I do okay? I did terrible. Okay. 6 points. So if you want to take if anything up there is valuable, you can feel free to take a shot of that. Again, we talked about Europe versus the US in terms of economics and multiples. We talked about key metrics being NDR, right? Higher NDR is more important than fast revenue growth. And then we talked about 2 moats in the form of instant payback period and community. And lastly, we talked about key tactics that every founder should have in your wheelhouse, which are secondaries. And my gosh, threaten the bridge round, baby. You're going to get them to just, that red line's going to look so pretty once you threaten the bridge round. It's going to come back. They're going to say, yes, guy, yes, guy, yes, guy, whatever you want, guy. All right, give you exactly what you want. So there you go. There you have it. That's sort of the summary. Again, if you want the deck, just leave a quick review on the talk and then email me, nathan@founderpath.com with the subject line London. Subject line London, you'll sort of get everything in there. Guys, thank you very much. Appreciate it. Hope you enjoyed that.